All right, today we're diving into something that is really shaking things up in the crypto world. Coinbase has rolled out a new way for you to get your hands on cash without, and this is the key part, selling your crypto. And how they're pulling it off? Well, it's pretty fascinating. And it all really kicks off with this idea from Ben Shen over at Coinbase. He says people should be able to get cash without having to sell the assets they truly believe in. This quote, man, it gets right to the heart of the whole thing. This is all about building tools for the long-term believers, the hodlers. So let's just pose the big question right up front, the one this whole product is trying to solve. What if you needed cash, for a down payment on a house, a new car, whatever, but the thought of selling your crypto to get it just doesn't sit right with you? Well, that's the exact puzzle we're going to unpack. Okay, so first things first, let's just break down the announcement itself. What exactly is Coinbase offering here? At its core, the offer is actually pretty simple, but it's incredibly powerful. If you've got Ethereum sitting on Coinbase, you can now use that ETH as collateral to borrow US dollars. Well, technically USDC, the stablecoin. Think of it like a home equity loan, but instead of your house, it's your digital assets backing it up. And we are not talking about some small-time experiment here. You can borrow up to $1 million. Now, a number like that tells you everything. Coinbase isn't just going after the casual user. They're aiming this squarely at high-net-worth folks and even institutions that need access to some serious cash. Okay, so why is this such a game changer? Let's get into the single biggest advantage for anyone holding crypto, getting access to cash without having to sell. This slide lays out the classic dilemma perfectly. So you need money, but the second you sell that ETH, boom, you've got a taxable event on your hands and you have to give a cut to the taxman. This loan creates a whole new path. You get the cash you need, but since you never actually sold your Ethereum, you don't trigger that capital gains tax. It's a huge deal. And that is the absolute key takeaway. For anyone who's bullish on Ethereum long-term, this isn't just some loan. It's a really sophisticated tool for managing your money. You get to keep your ETH, hoping it goes up in value, while still tapping into its spending power for your real-world life. And if you're sitting there wondering, is there really a market for this? Just look at this number. Coinbase already had a similar loan product backed by Bitcoin, and people have borrowed over $1.25 billion. So yeah, this isn't some niche concept. It's a proven massive market, and now it's opening up to the entire Ethereum ecosystem. Now, for what I think is the coolest part of this whole thing, how does it actually work under the hood? Because this is where it gets really innovative. We're talking about a mashup of two totally different financial universes. See, this isn't just Coinbase acting like a regular old bank. Nope. They've built this hybrid system that takes the best of both worlds. The regulated, easy-to-use experience of centralized finance and the automated, transparent power of decentralized finance. So let's do a super quick definition. CeFi, centralized finance, is what you're used to. It's a company like Coinbase or your bank providing a service. DeFi, decentralized finance, is totally different. It's financial tools that are just code. They run automatically on a blockchain, no middleman required. And this table just breaks down that division of labor perfectly. Think of Coinbase as the friendly, regulated front door. They check your ID, make sure you're allowed to get a loan, and give you a clean, simple app to use. But the engine, the thing that actually holds your collateral, figures out the interest rate, and enforces the loan terms, that's a DeFi protocol called Morpho. So Coinbase brings the trust and the simple user experience, while Morpho brings the automated, unstoppable on-chain machine. Okay, but, and this is a big but, whenever you're dealing with a new financial product, especially one that's mixing these two worlds, we absolutely have to talk about the risks. So let's dive into what you really need to understand before you even think about doing this. Because there's always a catch, right? I mean, all those benefits of automation and cutting-edge tech, they come with their own unique and pretty serious set of dangers. I want you to burn this number into your brain, 86%. This is without a doubt the most important number for any borrower. It's the liquidation threshold. Okay, so let me explain. Your loan-to-value ratio, or LTV, is just your loan amount compared to how much your Ethereum collateral is worth right now. If the price of ETH crashes, your LTV ratio shoots up, and if it hits that 86% mark, the Morpho protocol will automatically instantly sell your ETH to pay back the loan. There's no phone call from a loan officer, no grace period. It's just code executing a command. It's ruthless. And look, it's not just the price you have to worry about. Your crypto is being held by a smart contract. What if there's a bug in the code? The system also needs these things called oracles to feed it the real-time price of ETH. What if those fail? So the big takeaway here is that you're essentially swapping one type of risk, the risk of a company going bankrupt, for a whole different set of technical, DeFi native risks. All right, finally, let's peel back one last really interesting layer to this story. There's a curious little detail about where you can and can't get this loan.
You can get this loan pretty much anywhere in the United States, except for New York. And the reason why tells you so much about the constant tug of war between crypto innovation and government regulation.
The reason, in a word, is the BIT license. It's this famously strict, some would say infamous, set of rules from New York regulators. We're talking about one of the oldest and most demanding crypto rulebooks on the planet. And this is where you really see the clash. In New York, a company like Coinbase can't just wake up and launch a new product. They need to get pre-approval for any material change to their business. And you better believe that telling regulators you're going to let a DeFi protocol hold customer assets is a massive material change. The hurdles there are just incredibly high compared to pretty much everywhere else. So what did Coinbase do? They made a business decision. Instead of getting tangled up for months or even years in a brutal back and forth with New York, they took the pragmatic route, launch everywhere else, get the product out the door, and deal with New York later. Which leaves us with this final massive question. This hybrid model, blending the trusted name of a regulated company with the raw efficiency of decentralized code, it's incredibly powerful. But as the whole New York situation proves, it exists right on the fault line between the future and the old guard. So is this a genuine glimpse into the future of all finance? Or is this just the opening shot in a long, drawn-out battle to define the rules for this brave new world?